Hello and welcome to another episode of Full Court Finance here at Zacks. Today we're taking a look at three cloud-focused business services stocks, which are Cloudera, DocuSign, and Slack, before they report their earnings this week to help see what longer-term investors might want to do with these three stocks. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we get into the three stocks, I quickly just want to do a little bit of a market overview and a little coronavirus talk and maybe what's coming down the road next, just to help give a broader picture that obviously then these three stocks will be affected by. So stocks have climbed over the last few weeks, with the S&P 500 now up over 8% since May 13th and over 35% since the market's lows. The recent positivity, which has seen the S&P 500 climb back over 3,000 and the Dow climb above 25,000, comes as economies start to reopen around the world and U.S. states roll back coronavirus lockdown measures. And so far, the recent protests and some unrest around the country and really the broader world in general have not seemed to deter investors. Thus far, we did see last week's jobless claim data highlight once again the devastating impact that the coronavirus is still having on the economy. But the numbers are, however, trending downward, which is a good sign as more and more businesses start to begin to reopen. And on top of that, we could see the market continue to climb on the back of the Fed's massive support in the U.S. government's move to help boost the economy. And we should also note that tech stocks, which we're going to be talking about today, have continued to lead the charge, which is a good sign since they're often less impacted by the current economic lockdowns. So it's not that people are just diving back in to all of these stocks, irrespective of what's going on with their individual companies being impacted by the shutdown. Plus, there are also signs of an economic recovery being relatively quick coming out on the other side of this. So our director of research, who is also my boss, Shiraz Mian, wrote a piece last week talking about earnings, so last Friday, where he laid out three reasons why the coronavirus economic recovery will be quick. I'll quickly go through those and then we'll jump into our stock today. So first, he wrote a lot more than I'm going to touch on, but his basic 3 points are: first, the U.S. economy entered this downturn in very good shape. He goes into more detail about all of that. Second, and these are somewhat obvious, but that's also why it makes so much sense. The second point is that the engineered, and I'm reading from his piece, the engineered economic shutdown pushed the economy into a recession, but it was a necessary act to slow the spread of the virus and reset human behavior. With most states at different stages of reopening their economies, we can expect economic activity to steadily start resuming. In this outlook, June will be better than May, and May will be better than April, which was most likely the downturn's bottom. So heading in the right direction there. And then third, the policy response, and this is once again quoting him, the policy response has been unprecedented, both in terms of size as well as reach. Actions by the U.S. Congress, the Treasury, and the Fed has ensured that short-term liquidity problems don't become systemic solvency issues that will hobble the economy for a long time. Congress may need to do more in the coming weeks and months, but the U.S. authorities, whatever it takes attitude, has provided the necessary bridge to the other side of this pandemic. So some positivity looking ahead to why this economic comeback could be relatively quick. So with this in mind, we're going to turn our attention to Cloudera, which trades under the ticker CLDR. And they are the first of these three companies set to report their first quarter fiscal 2021 earnings results after the market closes on Wednesday, June 3rd. So far, shares of Cloudera have skyrocketed 100% since March 18th, as Wall Street starts to clamor for stocks that appear relatively immune to the coronavirus economic downturn. And we're going to just dive into sort of the simple overview of Cloudera. They are an enterprise cloud data firm that completed their merger with big data peer Hortonworks in January of 2009. The firm boasts that it can transform, complex data into clear and actionable insights, and its newer Cloudera data platform is more robust, and it aims to help businesses really better understand their massive amounts of data. This is the era of endless amounts of data across various public cloud and different platforms. And despite this recent climb, overall, Cloudera has largely struggled since it went public in April of 2017. And its stock tumbled last June after it announced that its CEO would retire. And the company later that year, so in August of 2019, reached an agreement with activist investor Carl Icahn. The famed investor hoped to help turn a new leaf in this company that he took a big stake in because he saw it as relatively undervalued at the time. And then in January 2020, so to start this year, the company got a new CEO who took over after previously co-founding and running Hortonworks, who they merged with at the end of 2000 or at the beginning of 2019. So far, Cloudera topped our fourth quarter fiscal 2020 estimates in March, with the company's annualized recurring revenue up 11% in the quarter. And the company basically said overall that their new Cloudera data platform, which they call CDP, will transform from a mostly on-premise enterprise data management vendor to a truly hybrid multi-cloud data platform. And this service will reflect our competitive advantage in addressing the full life cycle of data. So they're trying to become a more robust company that focuses on the beginning to the end of all of your company's data needs. But as I mentioned, Cloudera shares have soared 100% since the middle of March to blow away fellow stay-at-home standout Zoom, which is up 70% over that time. It is worth pointing out, though, that Cloudera stock is still currently trading under $11 per share. So it's certainly one that would be considered cheap by most people. And it has traded, so it went from trading underneath $6 all the way up to its current price. And it has traded as high as $12 over the last year. And we should also note that the stock remains well off its early days as a public company, where it's trading well over $20 a share. So it really hasn't gotten anywhere close to where it was when it initially went public. So with this in mind, and as one might expect then, since its stock price has not fared very well, its valuation picture is still somewhat solid, and that's why Icahn might have liked the stock to begin with. It's trading at 3.7 times forward 12-month sales estimates, which marks a discount compared to its industry's 7.5 times average, and it's not too far off its own one-year median. So with this in mind, our Zacks estimates are calling for its first quarter fiscal 2021 revenue to pop 8.6%. And on the bottom line, it's expected to climb from an adjusted loss of 13 cents per share in the year-ago period to positive 1 cent per share. And then this positive bottom line trend appears even stronger for fiscal 20, the full year and next year. So overall, its bottom line revision activity has turned more positive recently as well. And it has topped our bottom line estimates by an average of 95% over the trailing 4 periods. So therefore, some investors might want to take a chance on Cloudera heading into their earnings release. The stock is currently a Zacks rank number 3 hold, and it could continue to climb as investors really look for companies that are somewhat immune to the coronavirus downturn. However, there certainly could be a pullback in order given its massive run, and longer-term investors might want to look elsewhere since Wall Street still seems relatively unconvinced that Cloudera is going to be a great long-term option within this massive and crowded quote-unquote cloud space that includes lots of different companies. The stock is down over 50% over the last 3 years. So maybe pay attention to their earnings call tomorrow night, so Wednesday night, for any new outlooks on what's next for this company that, as I said, has really failed to gain the traction that many had expected when it initially went public. So given this massive run, it might be one to hold off on, at least for now, especially if you're trying to play it for a near-term gain or earnings, as that's always a risky play. And then longer-term investors might still want to see what happens in the near term, given this recent run-up of the stock where it's up almost 100% in the last couple of months. And we should also note that its longer-term growth is not really there yet for what maybe people would expect. We're calling for our fiscal year estimates to grow 8% on the top line this year and 9% on the top line next year. So now we're going to move on to DocuSign, which is another stock that has soared as part of this broader stay-at-home coronavirus immune stocks. The stock's up 95% overall in 2020, and this crushes the broader tech space as its business really is tailor-made for not only the current environment, the work-from-home environment, but the digital age in general. So with that in mind, they're set to release their first quarter fiscal 2021 results after the market closes on Thursday, June 4th. And as its name suggests, the company allows businesses and other organizations the ability to sign contracts in documents electronically on what they say is practically any device from almost anywhere at any time. And obviously, they can't say everywhere at any time on any device. And the company's offerings are increasingly valuable in our mostly digitally focused business world, which stretches from small mom and pop shops to really global titans. DocuSign boasts over 500,000 customers around the world. And when you think about it, I mean, as we mentioned, the basic business premise is pretty simple and straightforward, and it's certainly going to be around for a long time, giving people the ability to sign documents that vary electronically. So last spring, the San Francisco-based firm introduced its new DocuSign Agreement Cloud that helps firms, quote, automate and connect their entire agreement process. So this cloud-based suite offers over a dozen apps for e-signature, document generation, contract, lifecycle management, and more, with industry and department-specific solutions there as well. And we should also note that DocuSign's Agreement Cloud has hundreds of pre-built-in integrations with other applications, which includes giants like Microsoft and Google and Salesforce and more. So that's a positive sign as well. The company is also coming off a strong fourth quarter that saw it top our estimates and provide upbeat guidance. So now we're going to take a look at some other fundamentals before we take a look at what to expect this quarter and going forward. So DocuSign went public in late April of 2018 and found some early success before struggling a bit. With that said, DocuSign shares, as we mentioned, are up about 150% in the last 12 months and 95% in 2020 to destroy its industry's roughly sideways movement. DocuSign has also gotten a lot of love along the same lines as Zoom with these stay-at-home standouts. Yet, maybe longer term, its business might be more stable and attractive longer-term play that obviously people could continue to video chat once we were on the other side of the coronavirus. But no matter what, people are still going to be signing documents, most likely electronically, for the foreseeable future until we have maybe new technology we can't even think of at this moment. With that said, DocuSign is trading at a solid discount compared to Zoom at the moment as well, at 16.5 times forward 12-month sales estimates versus Zoom's 44 times. So it's 16 versus 44 in terms of forward 12-month sales. We should also note that its fiscal 2020 revenue jumped about 39%, and this was on top of last year's 35% expansion. So moving on, our current Zacks estimates call for DocuSign's Q1 revenue to jump roughly 33% to hit $284 million, with its full year sales projected to climb over 34% to hit $1.3 billion. And then on the bottom line, the firm's adjusted quarterly earnings are expected to climb an impressive 57% to come in at 11 cents per share, and better still, its adjusted fiscal year earnings per share figures are projected to surge 71% this year and another 52% in fiscal 2022. Overall, DocuSign is currently a Zacks rank number 2 buy that boasts some strong grades within our style score system. The company has also crushed our quarterly earnings estimates in the last 2 periods. And we should note that DocuSign currently sits just off its recent highs. It actually touched a new intraday high Tuesday morning. So some investors, as with all of these stocks, might want to wait for them to cool off amid this big market climb. But any longer term investors might look back in a year or two from now and think that DocuSign's current price could be quote unquote a steal. So any longer term investors might certainly want to consider DocuSign as a bet on sort of the continuation of our digital economy where people are still going to need to sign things. It's just all going to be done electronically going forward. And now we're going to close with another one of these stay-at-home stocks that's cloud-based business services focused, and that is Slack Technologies. It trades under the ticker WORK, and its shares have surged over 65% in 2020 against its industry's 5% decline. And the work-focused communications company also saw its stock price jump another 6% on Monday and popped Tuesday morning as well. So this means that investors might be expecting pretty big things from its Q1 results that are due out Thursday after the closing bell. So now we're going to take a quick overview of Slack and then see what to expect going forward. So it's a cloud-based work communications platform that aims to really bolster and improve productivity in a work remotely, work anywhere sort of age that obviously the coronavirus has brought to the light. And the firm allows users to send messages, images, documents, and more to groups and individuals. Think of it as kind of like a beefed up Skype, you could say. It's competing kind of along those lines. So its tagline is one platform for your team and your work, and its offerings compete against giants such as Microsoft and Google. It topped our fourth quarter earnings estimates in March, and its fiscal 2020 revenue jumped 57%. And I want to jump quickly into what it's done recently to just give people a sense of where it's growing. The company's ability to attract larger customers has really helped drive some of that recent sales growth. It ended the year with 70 enterprise customers spending more than $1 million annually on Slack, which was an 80% climb from the year ago period. Overall, they ended last year with 110,000 paid customers and roughly 900 of those customers spending over $100,000 annually, which was up 55%. So it's these larger customers that Wall Street was initially pretty worried that they weren't going to be able to get, especially in a crowded market with really established tech giants offering similar services. So their CEO, Stuart Butterfield, said in prepared remarks last quarter that as the shift from email to channel-based messaging platforms continues, the largest companies around the world are choosing to standardize on Slack because our enterprise-grade scalability, security, open platform, and ease of use and innovative roadmap. So they're calling it a channel-based messaging platform. That's kind of the broader thing. Just anything that's going beyond your standard email, that's what they're hoping to get, and they're competing against Microsoft Teams and various other platforms as well. So other fundamentals we should take a look at before we look at what to expect going forward. The company went public in June of 2019, and as I mentioned, it struggled early on alongside other IPOs from 2019, Lyft and Uber. Wall Street was worried that it won't really be able to attract those large customers to compete on that big scale with these big tech giants. But as we just mentioned, they have been able to add some bigger firms, and the stock has been on a tear in 2020. Shares are up 65% in 2020 and 85% since late January as Wall Street, as we've mentioned a couple times now today, but it's just that broader theme that might continue for some time to jump into stocks that seem they can grow during the coronavirus economic downturn and beyond, since if you can grow now, you're most likely to be able to grow in the future as well, especially within this growing cloud space. We should also note that Slack stock has soared nearly 120% since mid-March to outpace fellow stay-at-home standout Zoom's 90%. Work closed regular trading at just over $37 a share on Monday and jumped a little bit above that Tuesday morning as well. So this is not too far off its closing price on the first day it went public in June 20th of 2019, when it closed at $38.62 per share that day. And Monday was the first time it closed above $37 per share since last June 28th. So we're getting back to that IPO range that the day it went public. So we'll see how the stock reacts there, but it's certainly been on a massive tear recently, and it'll really be a big proving day when they report on Thursday to see what the stock does in the near term and if it's able to break through some new highs. So with this in mind, despite it sitting near its highs, its valuation is pretty solid. It's trading at about 20.5 times forward 12-month sales, which is well below its highs over the last year of 28.1 times forward sales. So looking ahead, our Zacks estimates call for Slack's first quarter sales to climb over 38%, and this would mark a slowdown compared to Q4, but it would come on top of the year ago period's 67% growth. So the continuation of solid top line growth. And if we look ahead to the full year, its revenue is expected to climb 36% and then another 33% higher next year to cross over that $1 billion threshold at $1.14 billion. And then alongside this expected top line growth, its adjusted losses are expected to shrink. Its expected Q1 loss is expected to come in at 7 cents per share versus the year ago period's loss of 26 cents per share. Overall, its earnings estimates have remained unchanged recently. This helps it earn a Zacks rank number 3 hold. That said, it has topped our quarterly earnings estimates by an average of 46% in the trailing 3 quarters. And like with all of these stocks, playing Slack or any of the stocks we mentioned for near-term gains around earnings is certainly risky, especially given all these big runs of these stocks. And work could fall if they fail to impress, especially given that massive run. But longer term investors certainly might want to take a look at Slack as a bet on the future of business-based communication that's still trading at around under that $40 a share threshold. So it might be a longer term bet alongside DocuSign. And then Cloudera still seems maybe out of the 3 to be the one that's the most up in the air, since it's never really gained steam until this recent coronavirus downturn. So we'll see what to expect going forward from all of these stocks later in the week. And obviously, longer term investors want to think about holding off no matter what. And if you're trying to play these stocks around earnings, we've given you as much information as we can to go with on these 3 stocks that have really climbed in a big way based on this cloud ramp up that the coronavirus has spurred going forward. So that's it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.